Okay, we're going to talk about currency markets towards the end of quite a dramatic year. My name is Yohay Elam. I'm the founder of forex. It'll be a session of about 45 minutes, including questions and answers, so my actual talk will be a bit shorter. And let's start. Very quick presentation of myself. I used to be a retail trader and also a computer programmer. I founded forex back in 2008. It focused more on fundamental analysis, but also touch technical analysis. That's what we'll do now. We'll talk a bit more of events moving the markets and also touch a few technical lines. So these are the topics we'll cover. Of course, the U.S. political crisis, which hopefully will end sooner than later because it doesn't only matter for currencies but also for the global economy. European issues which are far from over, pound and its strength, what's going on in Japan, the Aussie, which is a bit less predictable now, the Canadian dollar, and the Kiwi. Of course, we'll spend more time on the first issues. Let's start. Okay, as we all know, the U.S. government is shut down for business. It's only a partial shutdown. But also, it already hurts the economy. It began hurting the economy once it became imminent. People were getting ready for it. Now that the government shut down, many people are not working, spending less. It's only 3 days in, but so far there's a bigger impact on confidence. If it lasts only another day or two, it won't matter a big deal directly to the economy, but it does matter in terms of confidence. And another thing is that economic indicators aren't published. Tomorrow is the big non-farm payrolls day. Well, no, it's not published due to the government shutdown. So it makes other indicators more important. For instance, jobless claims, which were published earlier today, and ADP yesterday. Today we had the ISM, just an hour ago, ISM non-manufacturing PMI, which came out weaker than expected and hurt the dollar. In general, this whole crisis hurts the dollar. It hurt the dollar at the end of September towards the shutdown, and it hurts it even more now, especially as the debt ceiling is also getting closer on October 17th. The U.S. economy is fragile. If it lasts too long or if there's some kind of default, the U.S. could plunge back into a recession. And more importantly is this slide. Federal Reserve, has the biggest control over the market. All the talk towards tapering, and eventually tapering didn't happen. This moves the markets more than anything else. Now, the Fed said that didn't have enough evidence to go on to taper QE, to stop printing dollars and pushing them into the markets and devaluing the dollar. It said in September 18th that it needed more evidence. Well, not only does the government shutdown hurt the economy, but the Fed doesn't have the evidence. The data isn't published in order to reduce QE. So it probably will not happen this year. There's still a small chance in December. At first I thought it would happen that there was still a chance in October, but after the shutdown, December also seems like a remote option. One currency that would not benefit against the dollar is the Japanese yen, because as long as QE is extended, stock markets go up, and stock markets in Japan especially, but also in the United States, when they go up and dollar yen goes up, it means the yen is weaker. But in general, more QE is weaker dollar, more dollar printing, dollar's value, and the dollar's value goes down. The much bigger event than the government shutdown in terms of shocks is a potential default. The U.S. has a debt ceiling. If it passes the debt ceiling, it cannot pay its debt. Currently, the Treasury in the United States projects it will happen on October 17th. There might be some tricks to postpone it, but who knows? It's something that never happened. The U.S. is the biggest superpower in the world. It's quite unimaginable, but who knows? With the political brinkmanship, it might indeed happen. initial reaction will, of course, be dollar negative, and the biggest currency that could benefit from such an event is the Japanese yen, which is still a safe haven. And this is such a big event that also the euro could benefit. Why do I think the euro will benefit? Not because it's safe haven currency. It's usually a risk currency that falls on prices. But because such an event, the US default will be so big, the euro is an alternative reserve currency, and people could flock to it as it's more available, more accessible than other currencies. So the euro could also gain from such an event. The Fed could pump in if the US defaults more QE. It could also weaken the dollar. There could be other anti-panic measures like shutting down the stock market or any other anti-default measures. The baseline scenario is that this will not happen. There are still 2 more weeks. And there are some initial signs that maybe a deal might be reached, or at least a temporary deal. But this is the biggest event moving the markets now. I mean, of course, with relation to what the Fed does, and these things are not disconnected. So we should follow this more than anything else. As mentioned, the longer the crisis continues, the higher the volatility, because there will be more fear, and every little headline from Washington will make more waves than it does so far. So every minor politician in the U.S. will have his moment in the spotlight, and we might have moves at unexpected hours. We're used to having moves on economic indicators, but now we'll have less economic indicators and more comments from Washington. So the impact might get bigger as the event, as long as this crisis continues. Of course, as I aforementioned, if the economic damage is bigger, QE from the Federal Reserve could continue, and this would weaken the dollar. We already have QE forever, $85 billion of bond buys, treasury buys every month. Of course, the longer the crisis, the bigger the relief rally. When the crisis ends, the dollar would benefit. If it happens today or tomorrow, the dollar will benefit a little. If it happens just before the debt ceiling is triggered, the relief rally will be bigger. As aforementioned, a last-minute agreement still has a high probability, more than default of the United States. Okay, if everything is okay, let's look at the other events in the quarter. Of course, Federal Reserve is the most important thing. On the 9th, that's next Wednesday, the FOMC will release the minutes from the no taper decision. We'll get to see why the members decided not to taper and how close they were to taper. There were mixed reports about this. Now we'll get a much better picture. Of course, 17th is the debt ceiling, the ceiling of the debt ceiling, the date in which the U.S. could default, and probably not. That's another day to watch. The 30th of October is also a big day, because there's another FOMC decision, and Ben Bernanke and his colleagues will meet again. They are not expected to taper bond buys, no off taper, especially due to the crisis, and there's no press conference expected, but every word in the statement, as always, will be closely watched. And on the same day, just before the FOMC decision, the US will release its GDP, first release for third quarter. It will be very interesting to see how the economy is doing. On November 1st, 2 days afterwards, the non-farm payroll, assuming the government is not shut down. November 20th, the FOMC minutes, and this will give a hint towards December. And this December 18th is the next FOMC meeting. Ben Bernanke and his friends Ben Bernanke will hold a press conference. There still is a slim chance for a big tapering of bond buys in December. The shorter the crisis is, the better the chance is, but chances are falling day by day. Okay, that was the U.S. Now let's move to where I am in Spain, Barcelona. We'll talk about what's going on in Europe. Europe has seen some recovery, but the continent's certainly not out of the woods. German elections, she doesn't have a coalition yet. Learning from the past, these things take quite a long time. But eventually, she is likely to make a coalition with the Social Democrats, the SPD, and this government could be more pro-European, but it doesn't mean a stronger euro. Let's see. My opinion, Merkel needs to go and make big concessions towards the left, towards the socialists, towards Europe, in order to counter the hardliners in her own party. She's also seen as the queen of austerity, and she would like to defend her legacy, not to be seen as the one who is causing bad economic suffering for Europe. She would also need to work hard to convince the socialists to enter government. They already sat with her in the government 4 years ago, until 4 years ago, and afterwards they took a big loss in the elections. They were deemed redundant. So she'll have to work hard in order to win their hearts. She might be much more pro-European, anti-austerity, more pro-growth, perhaps allow for more inflation in Germany. Inflation is already falling in Germany and in the Eurozone in general, so it might be easier. And there are elections for the European Parliament in March, and she would have to prepare also for that. The election season is far from over. So currently we have a strong euro here in Europe, so inflation is indeed lower, but this is hurting Spain and Italy, which need exports. It also hurts Greece, which needs tourism, even though most tourism comes from Europe. On the other hand, it causes low inflation. This enables the ECB to act. Mario Draghi, president of the ECB, didn't reject a new LTRO. Also a rate cut, cut of the deposit rate to below zero. Everything is possible. He needs a bit more support from Germany and perhaps even lower inflation. Just yesterday, Draghi held a press conference at the rate decision, and it seemed he was not so pleased with the exchange rate. Why am I saying that? Because he mentioned the high exchange rate of the euro is one of the reasons for low inflation. I take it as a hint that if he sees that as inflation is temporary, as I said, then he expects the exchange rate to drop, and it's too high for him at the moment. So at the moment we're seeing a stronger euro dollar, assuming the US will resolve its problems. I think we could see the pair fall. If the US doesn't resolve its problems, of course the dollar will fall across the board. Another thing, Greece is still with us. Everybody already talked about the third Greek bailout. German politicians try to avoid that, but head of the Eurogroup, the IMF, everybody's talking about that. Now the German elections are behind us. Germany could move forward on that. It might also mean that Germany would take a loss. It might hurt the euro. But a new German government needs to be formed beforehand. About Greece could happen perhaps only in January, not in Q4. Italy, Berlusconi lost his last round. He tried to topple the government, but his party didn't support him. And maybe that's what happened in the US as well, with the Republicans, who knows. But Italy still has a big deficit, and it needs to tackle it. So far, Italian bond yields are quite low, and there's no real imminent crisis. But it's something to keep in mind, assuming the US moves out of the picture. Here's the charts for all of you that prefer a bit more technical analysis. And we saw euro dollar. This is a weekly chart of euro dollar, with the big lines marked on it. Euro dollar broke uptrend resistance line a few weeks ago, and it managed very well to stay above this line. The big line ahead is, of course, 137.10, which was the peak earlier this year. If it breaks this line, which is very, very important, 138.40, 140.10, this was the round number, and 142.50 are the next ones. On the downside, we have 134.80, which was the previous peak, 131 and 127.50, which was double or even triple bottom. These are really the big lines. I think that 130 is less important than it used to be. Let's move to the pound. Pound made a big rally. There is strong, solid, fast growth in the UK. However, a lot of it is concentrated in real estate in London. So it's not the best growth in the world, but the UK is certainly showing strong growth more than many other countries. It still receives some safe haven flows from the old continent, from Europe, from French who don't like tax policy, from Greece, maybe from other countries. This money, a lot of it still goes to real estate and already pushed, or at least pushed the real estate prices higher. Another thing that supports the pound is that Mark Carney, head of the Bank of England, said he doesn't see a case for more QE, more quantitative easing. Let's not forget, in the UK, the Bank of England will report 375 billion pounds into bonds, eventually into the economy. Not all of it to the real economy. But with the improvement, there's a low chance of more stimulus. So it also supports the pound against the euro, against the dollar. The UK, contrary to the Eurozone, needs a strong pound. Why? In the UK, there's higher inflation than we saw, for instance, in the Eurozone. And in the UK, the UK depends less on exports of goods, and inflation is relatively high. So lower inflation, a stronger pound would help curb inflation, would perhaps curb the housing inflation, and would help keep the interest rate low until 2016. 2016 is when the central bank said it would keep low rates. So until that year, it'll be hard for the Bank of England to keep that promise if the economy continues growing, especially if inflation rises. But if the pound is strong, inflation will rise more slowly, and the Bank of England will not need to raise short-term rates. But without QE, it might allow for higher long-term rates, and this would counter a potential housing bubble. All in all, there's more room for strength in the pound. I think it's the long term when we have potential. But let's look at, and the chart says that the rise has been steep. We can see it rising from the summer, from July, in a very steep line from 148 to around 162. When I made the snapshot, and we can see the channel. It's trading in a very nice channel. I'm not sure it can hold on to such steep rises, especially in the last 4 weeks. We saw, it's 5 weeks of consecutive rises. There is some room for consolidation. There are two resistance lines that are very close, 163 and 163.80. They're big lines on the chart, but they're very close. So we might see some consolidation over there. If the pair breaks higher, the lines that I see are 164.75, 166.15, and 167.50, which was a big peak 2 years ago. On the downside, it's 161.50 more or less. 160 is still a round number, and more important lines are 157.80 and 156. The general direction is higher, but there's room for consolidation. Next. Japan. This is less in the news, but Japan Prime Minister there announced the rise of a hike in the sales tax in April. This could curb growth and also lower inflation. Japanese government and the Bank of Japan are fighting inflation. They want inflation to rise. So the government announced that it'll counter this tax rise with new stimulus, new spending plans. But details are awaiting. The details will only come in during the fourth quarter. It'll be interesting to see. So if the plan is really big and ambitious, it could weaken the yen. And another thing that Japan promised, the government promised, is reforms. The third arrow of Shinzo Abe, the Japanese Prime Minister. So if the reforms are very ambitious as well, it could also weaken the yen. The reforms are still pending. More important at the moment is that stimulus. So for those trading the yen, there are stronger forces moving the yen. And it goes along with the stock market, safe haven status, but also it's important to watch stimulus line. Right. No, that's what I said. Countering sales tax. And the Bank of Japan. Bank of Japan made a huge move back in April, but it hasn't really acted since then. It announced much more QE. It released the limits on the way it acts in the market. But since then, it has held steady. So Kuroda, the head of the Bank of Japan, might also join in the stimulus and add stimulus of his own or announce new steps. We're seeing some results in the fight against inflation, but it's moving a bit slow at the moment, so we might see more efforts from the Bank of Japan during the last quarter of this year. Efforts could come faster and maybe even some intervention in the forex markets if the Japanese yen enjoys safe haven status and if dollar yen falls really rapidly. In any case, it's important to watch out the Nikkei stock index, especially in the Asian. I mean, it's open during the Asian session. That's when there are strong moves in Japanese yen in correlation with stock markets. There is also some correlation into the U.S. stock market, but it's a bit weaker. Also here, let's look at the charts. See an interesting wedge here. Actually, trading in dollar yen is slowing down. The ranges are falling once again. It isn't the terrible situation we had last year when it was around 77, 78 and hardly moved. But as we see this triangle from the summer, from May, June, the ranges are becoming more and more narrow, and usually when this happens, there's some explosion. To which direction? Well, I think the general direction of dollar yen is higher, but with the political crisis in the U.S., it could certainly fall. Assuming there is swift resolution in the U.S., we might, and stimulus in Japan, we might see another attempt on 100, in my opinion. Okay, Australian dollar. I used to really like this currency pair, but it fell out of love recently. We're seeing more balanced picture there, more choppy trading and less directional moves. Indicators are a bit more mixed. Some are worse, some are better. Retail sales against building approvals, for example. At the moment, the central bank has no easing scope for Q4. The statements released by the RBI are quite balanced. But we could, so in November and December, I don't expect anything to happen. The bank doesn't convene in January, but talk towards a move in February and will mount during Q4. So, of course, the RBA has strong influence. It seems that the current range is quite desired by Australian policymakers. I think they would like to see it a bit lower, but it's not. It's much better than it was before May. China has been sort of on the back burner. It had stronger influence on Australia. Also, there we're seeing stability. If we'll see new warning signs, of course, the Australian dollar will fall. U.S. political issues. The dollar is likely to strengthen. The U.S. dollar is likely to fall, as aforementioned. But as the Australian dollar is a risk currency, we could see a smaller effect on the Aussie. If we see more tapering by the Fed, this could have a more positive impact on the Aussie, more than a potential default of the United States. All in all, I see stability. Here's the weekly chart of the Australian dollar versus the US dollar. It broke a very big support line a few months ago, found the bottom at 88.50, and since then we've seen some choppy trading. After it conquered the 90 to 80 line, It's stabilized in a high range, but it's still choppy. It's still range trading lines as here. At the top, if Australian dollar rises 95.80, 98 to the course 30. The downside, it's 93.80, which is the current trading. It's not more of a pivotal line, and below we have 90.80 and round number of 90, and the bottom of 88.50. So let's move to the Canadian dollar. Many of you, I guess, get a boring currency. It had some good times, not that boring in my opinion. It needs U.S. demand more than oil. And when the U.S. is doing well, Canada is doing well, Americans buy Canadian products. So strong new non-farm payrolls in the U.S. often boost the Canadian dollar. If the U.S. enters a crisis, the Canadian dollar is one of the currencies that will not benefit quite a lot. Has little interest in that. There's some talk about a housing bubble in Canada, in Toronto and Vancouver. I think there is some kind of a bubble, but you never know when it's going to burst. So for those of you trading Canadian dollar day by day, it's important to follow this, but I don't know. It will probably stay on the back burner for quite some time. Let's talk about Canada and oil. I think here there's quite a change in the influence, or at least there will be a change in this quarter or later on in 2014. The influence of oil as a foreman is not that strong. Usually a few years ago, the Canadian dollar and oil were highly correlated. Now it has less impact. There's a big change. The U.S. exports a lot more. U.S. produces much more oil and it became an exporter of oil. This is a big change. So the U.S. now needs more peace in the Middle East that'll help global growth and demand. But it doesn't need. If there's less supply from the Middle East, it doesn't make such a big difference. Not for the U.S. and not for Canada. So all in all, the correlation is a bit weaker than it used to be. So it's more important to watch Canadian data and also U.S. data and a bit less oil figures. Canadian dollar strengthened against the U.S. dollar after the no taper decision because of them pumping more dollars and helping the U.S. economy in some way, but also Canada. There's a very, very long uptrend support line which hasn't been broken, not yet, going back for a long time. The weekly charts. So top side we have 103.60, 104.40, 105.50, and 106.70, which is a really important line. I think we're not going to see big changes. On the downside, it's 102.50 and 101.80, and of course parity. Assuming the U.S. resolves its issues, I think we'll see the Canadian dollar strengthening, but the move towards parity might be very, very slow. And for the last currency, a very strong currency in recent months, the New Zealand dollar. There's a housing boom in New Zealand, and the burst of a potential bubble doesn't seem that close. Contrary to Australia, New Zealand exports agricultural goods. People need to eat more than to build factories. So there's always demand. There was a milk scare a few months ago. That's over now. Many Kiwis who left New Zealand are coming back. All in all, they're doing really well. And the central bank is very hawkish as well. It wants a 2% hike up to 2016. This is very different talk from what we see in Europe, UK, and in the US, where there's forward guidance to keep low rates. And there's really a fight in housing demand to fight. The central bank fights housing demand, fights potential inflation. We might see, a rate hike in Q4 is quite unlikely, but the chances for a rate hike will grow, and we might see more upside. Now the Kiwi will soon see the chart. Made a huge rise on the no taper decision back on September 18, but it fell quite quickly. The rise was was too fast. So that's why I'm saying it could have a second wind. The Kiwi could have a second wind. But I believe it's ready for a more steady gain. It needs a moderate dose of U.S. political crisis. Like Aussie, it's still a risk currency. It doesn't need a huge global disaster. But as long as the Fed keeps on pumping, or even if the Fed cuts QE, the Kiwi dollar has a lot of potential to enjoy more rises. Let's look at the chart. Here, it traded in a very wide range like the Aussie for quite some time, and recently made a big break higher. It fell to support. That's 81.90. Below we can find 81. The round number of 80 and 15. More important line, I don't know why I did right here, is 76.90. On the top side, currently 83.60 is some kind of resistance, but the more important line is 84. 75, 85.80, and the high of this year, 85.80. I think we could see more of a steady rise in the Kiwi and less what we saw now is what we've seen in the past few months is violent choppy range trading. I think it will become a more smooth, fair, more directional currency pair. All in all, I believe we can expect high volatility in the market. We had a dramatic year everywhere, tapering, no tapering, improvement in Europe, improvement in the UK, downfall of the Aussie, downfall of the yen, and we might see a bit more of everything. The longer the US crisis lasts, the longer, the higher the volatility will be. In my opinion, I don't think there will be any quiet period until Christmas. The date for the last Fed decision, if I haven't mentioned it earlier, is December 18th. So I guess we'll see a few more days afterwards of action. Christmas Eve is December 24th. So I think that Q4 will basically end somewhere around December 22nd, 23rd. But that means action until the last moment, with lots of things on the agenda. Lots of opportunities, but also lots of risks. There's more action in the markets. That means you should trade with the less leverage and trade carefully. Okay, that's it. Now I'll look at the questions and answer more. I want to hear what you think will happen in Q4. I'll bring the chat window closer to me. Let's see. We can see it now. Okay, John Savage, do you see the US dollar not being the world reserve currency in the future? No, I think it will be a reserve currency for a very long time. But there are, apart from the number one reserve currency, there are also number two and number three. These are the bigger currencies. Of course, euro is number two. So if the US defaults, that's when I think the euro will benefit. But US is still the world power, and as now a net exporter of oil, I think US dollar will remain reserve currency for foreseeable future. Next question. Another country in the EU that can cause some problems like Cyprus not so far ago, maybe Slovenia. Yeah, I wrote on forex currency in the past, of course, about the crisis in Cyprus and Slovenia. Yes, I must say I didn't follow Slovenia in the last few months, but I'm not sure anything has been solved over there. Regarding Cyprus, the precedents that were there were very dangerous. And just a second. So with dangerous precedents, I mean, I have a bank account here in Spain, in a Spanish bank, and I know that if I hold under 100,000 euros in my bank account, I'm safe. I mean, the bank will take commissions, but and after the crisis in Cyprus, after they wanted to seize money out of insured bank accounts of up to 100,000 euros, I feel less safe, and I think it didn't happen at the end. They changed their mind. They didn't take money from insured bank accounts, but I still think it's the mere idea of having such a thing was very bad for confidence, and Cyprus is far from over yet. Capital controls are still in play there, so it's currently in the back burner. But like Greece, like any other country, it could be a front page crisis within seconds. Next, what's the reason for Brit growth? Most of the British growth was in real estate. It came from foreign demand. I think also prices plunged, so they made some rebound, especially in London. The Olympic Games brought a lot of investment there. I've been to London a year ago, a few months before the Olympics, and they saw lots of cranes everywhere. Export manufacturing is also growing a bit, and we've seen some financial industry. It's always been well. There's too much growth in construction, too much in London, less in other areas. It needs to pass on to other parts of the economy. Hopefully it will, but someone here gave a reason. Blakey, a new baby heir to the throne. Perhaps the Jubilee, in addition to the Olympic Games, the royal wedding, royal baby, all these royal things, maybe also the UK economy. I think they fell out quite sharply, and they managed to stabilize their banks. And there is a danger that this growth will remain only in housing, and it'll become another bubble. Policymakers need to be careful to balance this growth. Any more questions? Things that need to be clarified. Okay, so we want to show you the last slide here. And, of course, I want to thank you all for coming. I wrote the view. Everything I said here is, of course, available. Will be available on FX Street. You can watch the webinar again, and I'll have a full report on my site. I hope it will be today, but it'll probably take a few more days. Anyway, you can visit site forexcrunch.com. Contact me on my email address. Thank you very much for the kind words. I try to focus on the big picture. Thank you. Recently launched the applications for Android and for iOS, and that's my Twitter handle @forexcrunch. Thank you very much for the kind words. Any more questions? I think we have a few more minutes if anyone wants to ask something. GBP maybe. What about GBP? What about British pound? It's a good opportunity to some last comment, but a good opportunity to mention FX Street's meetup. I'll be attending the upcoming meetup in Barcelona, so it's even walking distance from my house. There's also a meetup in London and in New York. I don't know. I'm sure they'll be exciting as well. All the meetups I've been to in Barcelona were fun. You get to learn something new. You meet people who are like-minded. This makes trading not so lonely. And of course, there's also a fun part where you have some drinks, and that makes people more relaxed. Talk about markets, talk about wins and also losses, as we're mostly stuck with our noses to the screen. It's more interesting. Do you look at emerging market country currencies? I'm originally from Israel, and I do follow the Israeli shekel. but I don't write about it. It's not that interesting for the vast majority of my readers. I did notice the fall of the Turkish lira, the South African rand, the Brazilian real, like that. Of course, in the Indian rupee, which had a huge plunge. As long as the Fed keeps pumping, and thanks to politicians in the US Congress, I guess the Fed will keep on pumping, these currencies will probably stay stable after the big falls. The Aussie fundamentals with the Chinese. China is Australia's number one trade partner. Australia sells lots of commodities of iron, gold to China. Depends a lot on Chinese demand. That's why every indicator in China moves the Aussie. Recently, Chinese indicators have been relatively stable and moved the Aussie less, but just a month ago or so, we had examples when an Australian figure would be released at 1:30 a.m. GMT. The Chinese one would be released 15 minutes later. And the Chinese figure usually had a stronger impact than the Australian one. So that's why it has a strong impact. And the Australian dollar is sometimes seen as a proxy to trade China. China is the world's number 2 economy. So it impacts not only Australia, but all the world. It sort of took the burden of growth after the financial crisis. So that's why there's a strong correlation. Is China communist or capitalist? Ooh, that's a great question. But I'm not sure I'm certified to guess an answer. I don't think you can call it communist, but maybe half would be a good. I think they have a strong totalitarian regime that enables some free market, but with closed inspection. So half is a good description, but I'll leave that to somebody else. Yeah, China's the consumer. All countries due to its size, right? The New Zealand connection not as strong. New Zealand exports food, and there's more stable demand for food. In addition, New Zealand relies less on China than Australia. Australia is more reliant on China, and New Zealand a bit less. So even if there's a crisis and people need less electronic goods or clothes from China, or manufacturing needs onto Bangladesh or Vietnam, the milk coming from New Zealand, beef, sheep, people need to eat. Want to make better quality products. Yes. China, the Communist Party in China talked about moving to better grade of quality and growth. Less than it used to be, better than it used to be. More innovation, higher quality products. Another thing that's happening in China is that wages are rising. So Chinese labor is not that cheap. I even heard that there's some Chinese factories in Korea. Something that really surprised me. And if you just look at the labels on your clothes, you can see that you see less made in China and more made in Bangladesh. Or I've seen more made in Vietnam. I think they want to move to more domestic consumption and more quality products. But these are huge processes, long-lasting processes. The country is huge, so it'll take time. Any last question? Or I'll wrap it up. Here's the question slide. Gold. I don't follow gold that closely, but I don't see too much value in gold. I don't see it as a hedge against inflation. There's been no inflation, and I don't see it as a hedge. It's another speculation. I think there is demand for gold in real places, in India and China, jewelry, but as speculation against hedge against the collapse of the system, it's not so good. And if you fear a doomsday scenario, you need to buy physical gold and hold it under your, I don't know, mattress or something like that. But I don't know. I don't see gold rising too fast. No Kiwi supports gold, yes, but I don't see it rising. I think it has better potential to fall now. Yeah, that's a nice comment. No more capitalistic and communist states, more like oligarchistic and corporate. Yeah, that's a good, it's a good comparison maybe between the US and Russia. The real free market without strong powers and true capitalism is the perfect capitalism or the perfect socialist model. I don't think they exist. There's always something in the middle and a few people with lots of power. Any more questions about currencies or so I guess there aren't any more questions. These are my contact details. When is your next webinar? I still don't know. Depends on, I like the question. Thank you very much. I hope to do another one probably next month. Stay tuned. This is another great opportunity to thank FX Street for hosting the webinar, for all the contact cooperation, for all their support, and for the meetups, which I'm going to attend in half an hour or so here in Barcelona. But follow FX Street, stay tuned. I also publish it on my Twitter handle on my site, so know about it. Thank you very much. I also look forward to more webinars. So these are my contact details if you have any further questions. Hope nice time. Thank you. And see you soon. Thank you very much.